Chuck Carnevale. What you see here on the screen is a Graham Dodd adjusted graph of the S&P 500 for the last 20 years, where stock price is correlated to earnings growth, and the fair valuation, according to Graham Dodd, is 17.4, is also correlated to stock price. Stock price clearly follows earnings. It correlates very strongly, other than the irrational exuberant period from 1997 through 2003. But then look how strong the correlation has been since then. Earnings determine market price, and valuation is a critical component. You can see how overvaluation is really what destroyed the returns of the S&P over the last 10 years. Also note how strong earnings growth was coming out of the recession in 2001. You can see that earnings accelerated dramatically in the S&P, and the stock price followed that, even considering the fact that it was started overvalued in 2002. But from 2003 on, you can see this was a great period of return because you had decent valuation and high growth in the S&P 500. Earnings and valuation are critical. The 20-year track record of the S&P was only 5.5% for this 20-year period, which correlates very closely to the 4.4% growth rate of the S&P, coupled with a little bit of undervaluation in the beginning period.